It's October 2020. Yes, we are officially in the fourth quarter. I'm Alvin Tavares with another episode of How's the Market. All right, let's dive into the data. We're going to see a lot of the trends from the previous last couple of months continue. We continue to see closed sales go up. This month they went up 16.5%. We're seeing the median home sales prices go up. This month they were about 7% higher than they were last year. Our inventory rate is microscopic. Active listings are really low right now. We only have 3,209 active listings at the moment. That is 37% lower than where we were last year, and it's simply because if you already own a home, you're staying put. There's no need to introduce additional risk. Homes are also selling quicker. In fact, they're selling about 37% faster. So the average median time to contract, that means it goes on the market, so the time that is under contract is now just 51 days. Alvin, we're currently living in very turbulent times, but you keep presenting positive housing news. When are we going to start seeing the two collide? Although we are experiencing a lot of upward pressures that's pushing the market up, there are also some downward pressures. The first is that on a national level, we are starting to see some delinquency happening in various different markets. Although our market is here in Southwest Florida, a beautiful place, very attractive, attracting a lot of buyers from all different types of markets, a lot of the lenders are in New York, California, Chicago. They're spread out across the country. A lot of those banks have to adhere to national guidelines. This is FHA, this is Freddie Mac, this is Fannie Mae. At the national level, they are dealing with things that we may not be seeing here, but they're gonna act in accordance to what they're seeing on a national trend. And so when they start experiencing delinquencies, they're gonna be a little bit more stringent as to which loans they approve and the guidelines that they provide to all the other lenders. The other thing that we have to watch, banks are currently being asked to perform a stress test by the Federal Reserve. I'm not going to go into this in details, but essentially what's happening is after the last recession, where the Federal Reserve and the government bailed out a lot of the large banks, they realized they didn't want to do that again. So instead what they did is they decided to provide certain stress tests to banks to see how they would perform in different scenarios. Recently, the Federal Reserve gave out two scenarios for each of the 34 largest banks in the country to basically role play and provide facts based on their actual cash reserves, based on their actual income, based on their actual current business models to see how they would perform in various scenarios. So what we're seeing is a lot of banks are clamping up and they're not taking on as much at-risk loans so that they can perform better during these stress tests. So what we can expect is lenders becoming a little bit more sensitive. How that downward pressure will affect the rest of the market, we just don't know.